Testing.
Okay, welcome everybody. So if you're going to leave, head out in the back because we're going to get started with our next session. And today we are talking about the convergence of early stage venture funds and late stage growth equity funds. And we will also talk about the global venture scene because we have a distinguished set of panelists who are focused on many different regions in the world. So I'm going to quickly introduce them, and then we're going to talk about early versus late stage, and then talk about global VC. So starting with Murtaza Ahmed, he is the CEO and partner of Chiltern Capital, which does all emerging markets around the world, investing and advisory work.
Pretty much.
Luma, the CEO of Oasis 500, a pre-seed fund in the Middle East. Jenny Lee, who's managing partner of Granite Asia, a multi-stage venture firm. Billy from Apex Capital, doing late-stage growth equity in Latin America. And finally, Anand from Iron Pillar, which invests in India from Dubai, but India-focused fund. So, Jenny, let's start with you. Granite Asia, formerly GGV, multi-stage fund. You're investing in everything from seed to Series B, C, D stage companies. Where do you draw the line between an early stage venture investment and a late stage investment? When does the underwriting change? When does the diligence process change? At what stage do you delineate these two categories?
Yeah, sure. Hi, everyone. Very happy to be here. I think we have to speak very loudly to be heard. So in terms of definition, because we have multi-stage funds, they are structured as products, the best way to do it is to make the definition very simple. And so the way we define early stage right now between our early stage discovery funds and a venture growth fund is simply by valuation. And so we will move the valuation depending on the stage of the market. For example, we can cut a fund at 100 million valuation. And so deals that are seed or Series A or early Series B would then fall into the discovery early stage. And then anything after that, Series B, Series C, above 100 million valuation, we'll put it in the growth bucket. That's a simple way to make it easy for our investors so that they don't have to figure out, what goes, like how we define.
And what valuations what is a seed deal from a valuation perspective for you in Asia and in the US?
That's right. So valuation has come down substantially. So over the last 3 years, early stage valuation has come down from anywhere between 30 to 40%. And so a seed deal, depending on the sector, can be anywhere from 5 to 10 million pre-money. So that's the range. If you're earlier, before pre-product market fit, if you're 2, 3 people in the team, obviously you're then talking about the sub 5 million and below valuation. If the company is a little bit more advanced.
What geo are you talking about? Is this global average or?
Yes, global average.
Okay. And what's the difference in Asia, because you're based in Singapore, right?
I am in Singapore.
So what do you see in Southeast Asia versus US?
Okay, the difference is not regional, the difference is sectorial. So today, if you are AI and you have cybersecurity or data security in the very hot, emerging, growing sectors, then that's where valuation tend to be higher. I would say a typical Series A would then be in the 30 to 50 million valuation. Yep. But out of this cool sectors, then I think the rest of the sectors generally will be a lot lower, 20 to 30. So less about the region, though I think the region does represent certain risk underwriting that you have to come in, but that's an underwriting process. But from a valuation perspective, we have seen that it's better to classify them based on the sectors that they are in.
Yeah, one of the things we're seeing in the market is late stage funds coming to the earlier stage part of the venture market because of the correction post-ZIRP, where late stage deals were clearly overpriced. But we're also seeing early stage funds creep a little later stage as they try to follow on to their winners. I'm curious, Billy, if you can speak to what stage you focus on from a growth equity practice, and are you, how early have you crept over the last few years? What counts as a growth equity deal from your lens?
Yeah. So I wouldn't even call ourselves growth equity, but more a traditional buyout. But we've gone as early as growth equity. And it was basically driven because of our capabilities. So there was a very strong value-added component that we can bring to the table to this investment. It was an investment that we did. It was a convert between the series after the Series B and before the Series C. A profitable company, growing. So I think in our case, the reasoning behind going as early as we did was because of capabilities and value added, and also because the company was already profitable, and there were a lot of opportunities to continue to improve on those sort of profitability metrics that
Yeah.
we were able to sort of.
And Murtaza, a lot of early stage VCs, which is the industry I'm in at Village Global, we do early stage venture in Silicon Valley, say that late stage VC, late stage growth equity people are just offering capital, and it's hard for them to add value. But you do a bunch of advisory work.
Yep.
In addition to investing.
Correct.
What are the ways that late stage funds are actually trying to? How do you add value or win deals today as a late stage?
Well, I mean, it's a very good question. So when you actually talk to founders, I think what you'll find, especially at the later stages, is that founders aren't necessarily looking for operational value add. I think that's incredibly useful at the earlier stages, and I think that's presumably what you end up helping quite a bit with. Founders essentially want a couple of things in terms of their later stage partners. A nice person, not a jerk. They don't want to work with jerks. Somebody who's willing to move quickly and not waste their time. And then the sort of secret sauce that we perhaps add is the fact that because we work across different emerging markets, we're able to provide best-in-class insights from Southeast Asia to, say, Latin America, where the business model might be the same. And I think that's something that founders in each of these markets, because they'll never compete with founders in the other markets, even if they are the same business model, they find that insight exchange extremely valuable.
Yeah, that makes sense. The idea that you can do cross-market insight gathering
Correct.
is compelling. We're going to come back to you, but Anand, you just do India, right? You're only
Yes.
focused in India, so you're not looking at the rest of the world for insights.
No.
Is that because India is such an ecosystem unto itself that there are no lessons to be learned elsewhere? Or do you think if you took a global lens, you would be more effective at helping your companies?
Yeah, it's just a matter of focus, why we do only India, and there are two big pillars for our investment strategy, right? From a market perspective. One is India has been always very strong in enterprise tech, building from
Being strong at what?
enterprise tech.
Enterprise
So
tech, yeah.
SaaS and even other enterprise products, which can go global. So that's a big area where we bring in like help from Silicon Valley, etc., but to help these companies grow there, like go to market and things like that. The other piece is consumer, where India is one of the largest consumer markets already in the world. So you don't really have to kind of tap beyond India for that opportunity. So due to that, it's a big, potential $1 trillion market for any fund to kind of create massive outcomes in the next decade. So that's one of the reasons why we don't focus on anything beyond
You
India.
do early stage or late stage in India?
We do late stage. We do what you call as growth stage. So typically, our definition for us is 10 million plus revenue companies, but where we can see that the business can be a 150 million revenue business in the next 5-6 years and profitable. And this is very important because growth capital investing in every single country or every single market have its own different nuances. In India, if you really want liquidity, you want to go public market. And public markets in India is the 4th largest public market in the world. Soon to be probably the 2nd or 3rd largest public market in the world in the next decade. And it is almost fully now driven by local capital. So there is a massive amount of that, and they prefer profitable businesses. So if you go in India, say, hey, look, I'm building a new LLM model which is going to make profits in 10 years, the public market investors will come and tell you that come back after 10 years and I will probably look at your IPO, right?
Now, a lot of early stage VCs in India get liquidity on their investments by selling positions to late stage investors, correct?
Secondary, that's correct.
So how does that relationship work between the early and late stage funds? Like, are you frequently buying secondary from like seed managers in India?
So there are we are just doing a deal this week. We are closing that where there is also a secondary component where we are buying at a discount to what we are pricing the primary at. So it's a very good deal for the growth stage investors. Interestingly, a lot of growth capital investing in VC in India have a private equity element. So you would know like people like Temasek, Adia, etc. are very active in doing direct like growth stage tech deals in India, which you would normally not see. And they are like very large, writing $100 million, $200 million checks.
Interesting.
So secondaries is a big piece due to that aspect which I mentioned.
Yep. So Luma, let's talk about the Middle East. So we're doing a global tour here because we've got people covering India, Latin America, Southeast Asia, all emerging markets, Silicon Valley, and MENA. You're doing pre-seed and seed deals in MENA. Tell us about the strength of the early stage ecosystem. Is there too much capital at the early stage relative to the talent pool? Is there not enough? Because I've heard it argued that there's 1 million seed funds, but not enough growth funds. But maybe you disagree. So what's your take?
I disagree.
Okay.
I mean, just to put things into context, we are typically your first institutional check. So we are betting on non-consensus deals, and we need to be right. And it's very difficult to, assess whether this deal is going to make your return or not. And in alignment with our LPs as well, we also sometimes go upstream. Just to answer your question, that we do upstream deals just to build the brand as well.
Upstream meaning later stage?
Yes, so we do, sometimes we've done pre-Series B, which is not something that we normally do, and it's not our typical deal, but we need to do that because we need to also create a brand, and we need to have a quick win. We do have early stage investors, but they're more government-backed. We do not have commercial investors that come at the very, very early stage just because of how nascent this ecosystem is today. But as it matures, we're finding more investors coming in with LPs such as family offices, institutional LPs that come in and invest in first-time fund managers to cover that gap. We also have a gap of post-seed. We don't have a lot of growth investors in the region as well. So we have that gap that
So there's a
needs
gap
to be
at
covered.
every stage, you'd argue.
Absolutely.
Relative to the opportunity. So let's talk about some of the global markets specifically. So in MENA, we'll talk about every part of the world here, but let's start with MENA. What specific markets are you most compelled by, and what markets are kind of, like, we all know Saudi's, a significant player, but what markets are kind of overrated or underrated in your view?
So the UAE and Saudi are covered. I mean, if you look at the value chain, it's almost covered at every juncture. But if you look at, you have gaps in Egypt, you have gaps in Tunisia and Morocco, Jordan, Lebanon. You have funding gaps at every juncture. And I think there's an opportunity there, definitely, for global funds to come in and look at these
And what
deals.
if you believe markets are efficient, then certain investors are not going to those markets because they don't see opportunity. What are they missing? Like what's a Western investor or an India-focused investor? What do they misunderstand about these markets?
Some of these markets are too small, and they need to expand to bigger markets, but it's not borderless. So it needs to be, it's not a plug and play for every industry and every sector, and I think that's the challenge there.
Okay.
You can't invest in Tunisia, and then scale
Right.
if you are not building something for Africa, right?
But your argument is there are entrepreneurs in Tunisia that are
Absolutely.
seeking to build a global business and thus would warrant raising money from high-quality global VCs.
Completely.
So, Murtaza, tell us what markets in the emerging market world are you most, what do you think are underrated or overrated?
Sure. So the way we think about emerging markets is Latin America, Southeast Asia, Middle East, Africa, excluding India, which Anand covers, and of course China, which we discussed as hardly emerging and post-emergence. And within those markets, I guess the lion's share of our deal flow comes from Brazil, Mexico, Colombia in Latin America, Singapore.
So Latin America is Brazil, Mexico, Colombia.
Correct.
Okay.
With a bit of Argentina, with its sort of macroeconomic and political risks that arise from time to time, it makes it slightly less attractive. But again, amazing companies being built in Argentina. In Southeast Asia, I would say Singapore, of course, as a hub for the market, and then Indonesia as well. And then Middle East, Africa, Luma said it very well. I mean, there are quite advanced sort of tech ecosystems like Saudi, like the UAE, and then they're the ones that perhaps, require more attention, like a Tunisia.
So do you think, like, we've at our firm, we've invested in a couple of companies in Indonesia. We're 80% US.
Yeah.
But Indonesia is very compelling from a population perspective. But when you actually dig into the wealth of the country, it's still very poor.
Yeah.
There's very little buying power of the people.
Correct.
So there are statistics that are incredible, like only 3% of Indonesians have a credit card, something like that.
Yeah.
So there, you can imagine there's a lot of like interesting fintech opportunities. But the buying power is still a lot.
For sure.
I wonder if the population's luring investors in, and there's actually not as much there as people think. What are your
Look,
thoughts?
I think that's certainly the case to an extent across all of these markets. I mean, I think Anand will say the same about India, perhaps, right? I mean, the GDP per capita in many of these markets is still somewhat low, especially when you compare it to the markets Westerners are used to investing in. But the reality is these markets still constitute 30, 40, 50% of the world's GDP, the world's GDP growth, the world's population growth, the world's smartphone penetration, the world's middle class population. They're only attracting 6% of the world's VC capital. They only
6% is going to emerging markets?
Correct.
Okay.
They only constitute 2% of the world's public market capitalization. So while the point you make is true, the asymmetry is still enormous. And of course, the asymmetry has always existed, right? They're emerging markets for a reason. For this asymmetry, these markets can be risky to invest in, they can be difficult to navigate. But there are ways that I think everyone on this panel is finding to capture that asymmetry, to intelligently invest in that opportunity.
Well, I think it's something we've seen among LPs around the world these last few years has been a pulling out of some of the emerging markets and reconcentrating into U.S. funds or European funds. And so I think if you want to be greedy when others are fearful, a lot of people are fearful of emerging markets right now. And so they're I mean, India is accepted because India still feels extremely frothy, so much capital piling in India. But outside of India, which has been a beneficiary of funds or LPs pulling out of China, the emerging markets, it's been challenging the last few years. I think the data, Jenny, in Southeast Asia, venture financings are way down the last couple of years. Who wants to comment on your prognosis over the next few years? When will this turn around? When will we see more capital flowing into some of these global markets?
Yeah, I can talk about it. Actually, in Asia, you can make money. Our IRR from Southeast Asia emerging is over 30%. So I think
So
the way
say that again, the IRR of emerging
for Southeast
Asia venture funds?
for our funds
For
is
your
over
funds,
30%.
over 30% IRR.
Yeah.
Okay.
So like I think the way to look at it is that it's not one team, fintech, that works on a global basis. The way we look at Southeast Asia, for example, there are a couple of tailwinds. I think number one, digitization, the population dividend that we are seeing is indeed real. Number two, if you think about the world's growing middle class, 60% of the population is going to come from Asia over the next 10 years. So what we have been making investments in Southeast Asia is that you cannot go from a pure core technology perspective and like to look for open AI in Southeast Asia. It doesn't exist. But what's important is that when you look at markets like Indonesia, the things that works is combining technology enablement to traditional industry. For example, agri-tech, aqua-tech. You don't need a credit card because you have startups that could now, with a mobile app, allow you to travel with just an ID on the mobile app across Indonesia. So the level of innovation that we are seeing has to be localized. And the reason why Southeast Asia is able to enable and use this technology is thanks to China, immense production capabilities over the last 20, 30 years. Many of the IoTs, many of the sensors that we see today are actually at very good, reasonable price. And therefore, you can put together, startups can put together solutions which tend to have a hardware angle. No, so it's not just a clean, light software model. You do have to do a bit more to ensure that the solutions are tailored for the market.
Well, I do think there's a lot of interesting deep tech opportunities. The challenge is when you combine deep tech plus emerging markets, et cetera, it's like risks upon risks. But you're right, I think fundamentally there's so many incredible engineers in a lot of these markets building.
Right. And if I may, I think the other opportunity that's the reason why we're all here is that the world has changed and that new bridges needs to be formed. right? Over the last 24 years, I've seen US and China bridges being formed. Today, that bridge is across the global south. I've had China very good entrepreneurs coming out here to make bridges between China and here, bridges between Southeast Asia and India. And therefore, the world is changing in the sense that talent has feet, right? And talent will go to markets where it can be neutral, where capital, idea, and market access can be stitched together. So that's really a new opportunity. It's not a local opportunity, it's a thematic opportunity. So if you think about food, agri-tech, it's not just in Indonesia, it's also in India, it's also here in the Middle East. If you think about energy transition, obviously, Indonesia has some advantage given their warehouse of nickel. And if you look at India, for example, India is on the whole energy transition. And so the thematic here is about stitching all these themes.
So to the
and
point of
bringing them.
to the point of bridging, as we've seen the U.S.-China relationship implode, has China venture capital, Chinese LPs, are they showing up in your markets? And if so, how is that relationship playing out? Like, what's China's activity in India or the Middle East or other emerging markets, Latin America? What does that relationship look like?
Unfortunately, I can talk about India's case. So India have actually stopped Chinese investors from investing in Indian tech ecosystem, and that's actually a challenge. So it's a very...
So tell us more about that.
So in around 3 years back, there was a new law which said that if you have a investor from a few countries, you'll have to have a separate approval for that entire process. And it is actually quite interesting.
Is this for individual startups?
Individual
or
startups who are taking money from a Chinese investor will need to go to Reserve Bank of India and get a separate approval, which unfortunately is not going to come.
Now, does that hold for funds too? If you run a venture fund in India,
Yeah, if you're
you
a
have a
venture fund
Chinese
in
LP,
India,
you need special approval?
You need special approval.
Wow.
And that becomes challenging. So all this geopolitics is actually becoming a bit of a challenge. That being said, so before that, like if we go back to 2019, Chinese investors were almost same amount of capital they were investing into Indian tech companies. Like big companies like Flipkart had big investors like Tencent, right? Our largest gaming company in the country also had a large investment from Tencent again. Alibaba was a big investor in the largest payment
So what's
company.
going to happen going forward if it's given the new regulations?
So at this point of time, we don't know. It is actually kind of beyond people like our powers. Like, there is government-to-government conversations happening in getting the relationships back to the same place. But it is going to take some diplomatic effort and
go ahead.
I just want to say, I mean, like the geopolitics of it all is very interlinked, right? I mean, what you're seeing is, of course, the India-China dynamic taking place. You're seeing the US-China dynamic taking place. As a result of that, you're seeing a lot of the US capital that went into China now going into India. So, and many of the other emerging markets. You see Sequoia breaking up its funds into individual entities. You see other friends breaking up their funds into individual entities. China,
which is such an interesting dynamic. Like, like globalization continues to pace in some degree, but also the unraveling, like these global venture firms that had global teams. It's so emblematic of the moment we live in to see all of them disentangle themselves and have local offices with local brands.
Exactly, yeah.
It's kind of sad. I think to the point of sharing lessons, I think that's going to happen a lot less. I mean, I remember 10 years ago or 15 years ago, people in Silicon Valley would go to China to try to learn, and vice versa, share stories about growth and all this kind of stuff. None of that's happening anymore.
Oh, yeah.
And I think that's to the...
It's still happening.
It's still happening. Where there are sort of pilgrimages from China to the US and vice versa to learn about the cutting edge.
Yeah, I think, so money is fungible, and what we talked about in terms of geopolitics is forcing GPs like ourselves to be innovative as well. And so I think what you will see from that is that funds are going to be a bit more local, a bit more regional. But as a firm, the lessons learned from one country, one business model to another business model is the same, right? The key success factors of an e-commerce company, whether it's managing your SKUs or your business model, it's the same, but you have to localize it. So number one, definitely revamping of venture funds and the structure, number one. Number two, if you talk to an entrepreneur and you go down to the day-to-day and said, who do you want to, if you're e-commerce, who do you want to learn from? They will tell you it's the PDD of the world, it's the Alibaba of the world, because they want to learn from the best. And therefore, those meetings are happening, just not talked about. Because entrepreneurs are beyond politics. It's about fulfilling that vision getting the right solution to the end customer. And so the trips are happening, Indonesia to China, the Indians.
yeah,
I've had
a lot.
Indians entrepreneurs. I go to India every month. And I have had Indian entrepreneurs asking when are we organizing a trip for them to learn, not just China, but now they want to learn about Indonesia, they want to learn about the Middle East. And so I think that that's all going on the day-to-day. I want us as GPs also not to get too overwhelmed with media and what's being said out there, because it's one thing to look at all the news. It's also very important to know who are sponsoring the news. Maybe I'll just add that. At the end, it's about the company. Can they deliver value?
That is encouraging to hear about the global learning that's still happening. Luma, do you want to comment?
I just want to go back to your question about, the decrease in funding that's happening, across the board. I want to just emphasize the fact that everybody that raised, all the GPs that raised funds in 2020 and 21 are conducting their portfolio management activities for liquidity. They need liquidation events for them to go back to the market and fundraise their second and third funds. So I think this correction is very healthy. And I think moving forward, you'll see activity going back on the rise.
So let's talk about that. Let's talk, because we have just 7 or 8 minutes left. Let's talk about the next 5 to 10 years of venture. You called it a correction, kind of the Darwinian purge that's happened the last few years, which is healthy. One of the things that happened during the ZERP boom era was funds got way too big. And I'm curious how any of you think about fund size. I think 5 or 10 years ago, conventional wisdom in venture capital was you have to get really, really big or stay really, really small.
Absolutely.
Because their theory was only the barbell-sized funds will succeed. So you either got to get big like Andreessen Horowitz and have a huge platform team, or stay really small and nimble to try to 5 to 10x the fund. I think today a lot of the big funds are realizing they overscaled, that it's hard to 3 to 5x a $3 billion venture fund. And a lot of the small funds sort of accidentally scaled up to 100, 200, 300, 400 million dollars in size and are now trying to correct. How are some of you thinking about fund size? And then also tell us, what do you underwrite your fund to today? So for the growth stage folks, what are you telling LPs about the return, time to liquidity and multiple, and for the early stage folks, the same?
Sure, happy to answer that question. So there are a number of different lenses that you can look at for this, right? I mean, there's an entire global macro lens which dictates what's happening in markets, the timing of IPO windows and so on. There's a political lens with the US election and elections around the world. And of course, you've got to communicate something that's agnostic to those lenses, right? In our case, and I can speak for ourselves as a growth fund, we're underwriting to an IPO. We don't believe that you can build a scalable, successful business strategy hoping to exit through secondary or through M&A. I think you have to be able to underwrite to an IPO. A company you invest in has to be capable of being public, and for the most part, that means in the US.
But how do you, I heard this recently, there are fewer tech IPOs the last few years than even in the 2008 financial crisis. More tech companies are going public as Bear Stearns was unraveling in 2008 than the last few years, which is really wild. So when you say you're underwrite to the IPO,
correct,
what are you telling your investors about when that's going to happen?
Well, what we tell our investors is based on the fundamentals of the business.
Sure.
What we can't do is predict the market window and the nature of markets at that point in time. There'll always be a margin of error on timing of a couple of years, because that's generally the nature of the cycle in the market. But when we look at the fundamentals of the business, what we're talking about is how long will it take for the business that we're investing in to be large enough to be able to be publicly listed. And then around that, there's always going to be a margin of error.
So what's the time, if you're raising money from an LP today for a late stage fund, what's the timeline that you're saying?
We're saying 4 to 7 years.
4 to 7 years, till liquidity.
Till liquidity,
on the fund.
correct, exactly.
And who else do, Anand, what are you saying?
Yeah, I can tell you about how we underwrite and how we think about portfolio construction and fund size construction. So we are not really looking at individual assets, but we are really looking at every deal when we underwrite, can it return the fund, right?
How big is your fund?
Our fund is 250.
250 million.
250. So when we put 25 million into a company, can it make a 10x? Or when you put 50 million, can it make a 5x? Like, that's the kind of math that you're really looking at. So now, obviously, everything is not going to get there, but if you get 2 or 3 companies out of that portfolio there, you're already getting 3x, and then eventually you're trying to kind of make a 4x with the rest of the
So
company.
you're looking, you're underwriting, when you raise a $250 million late stage fund in India,
Return $1 billion back.
you're targeting that at 4x?
Yeah,
fund?
4x, return $1 billion back, 30% IRR in dollar terms. It's different. You have to think about the currency there.
Yeah.
It's a very important thing.
Right.
And do it in 7 years, average holding period, 7 years. So
7
that
years,
means
okay.
your first exit, your money will be starting coming out in probably year 5, but you may actually take till year 9 to kind of completely harvest the invest.
Yeah, and I think one of the interesting dynamics when we think about the session that was framed here of early stage and late stage converging is LPs want faster liquidity, which favors late stage, but so many late stage investors got ahead of their skis the last few years, investing at inflated valuations. And so there's also appeal to the low entry prices of early stage funds. So trying to find that happy balance of disciplined, low valuation investing while also getting to liquidity within a reasonable time period is challenging. You want to say one more thing?
One quick aspect about that, LPs wanting fast liquidity. Look, if you really go to some of the long-term investors in tech, they are actually saying the other way. I have LPs of us who come back, like we are IPOing 4 companies in the next 1 year. And some LPs actually are saying, why are you selling your stock now? Because we have seen this company and the company is actually compounding 40% for the next 5-6 years. You're in the company only 4 years. You hold it for another 2 years more. So
Well,
it depends on the LPs.
I think venture funds holding companies after they go public is very interesting.
Yeah.
I think 90% of Google's market cap or whatever is post-IPO. But Sequoia held Zoom and lots of other companies post-IPO, and that wasn't so good for their LPs. So it cuts both ways.
But they also launched their evergreen fund for this precise purpose, right?
They did, but
To
I think,
not leave
but
money on
arguably
the
launched it
table,
exactly the worst
Yeah,
time.
well,
I think they launched that evergreen strategy at the absolute peak of the ZERP era,
Yeah, correct.
when holding Zoom and all these companies would seem to make more sense.
Yeah, Ben, I actually want to give a plug to early stage fund. Well, we do early and late stage. Our funds are underwrite later stage about 3x, early stage about 4 to 5x. I think that right now it's
So
actually
sorry, you underwrite early stage to 3x?
our
4 to
later
5.
stage to 3x.
3x,
and
early
our
stage
earlier
4 to
stage
5x.
4
Yeah,
to 5x.
yeah.
Right now is the best time to invest. And if you are going to go into alternative venture, you have to have a 10-year lens. Why early stage? Well, our early stage funds are a lot smaller. It's 200, it's 300 million. But we are in the midst of a huge technology disruption, whether it's around climate change, whether it's around resupplying, you're building a global supply chain, whether it's about climate changes. Because of that, the early stage GPs there are new businesses, new CEOs, new solutions needed, and therefore the early stage is always an angle to allow us to get to that new ideas.
And I would
so
add-
you need that,
Yeah.
and then the later stage can come in to double down, lower risk, beta, but it is a good complement.
So I think it's a
Yeah.
good note to end on, which is the reason all of us are doing this work is because this is an incredible moment in history.
Yeah.
We're so privileged to be able to back entrepreneurs building in this AI moment. And there's so many industries that are going to get disrupted over the next 20 years
Yes.
because of what technology is enabling, which makes us all, I think, extremely optimistic. Despite some of the recent challenges, we're putting our time and our money into this asset class, and it's very exciting. So thank you all for being here, and we'll continue the conversation in the days ahead.
Thank you.
Thank you very much.
Thank you.